When you lose your labor market, inflation becomes temporary. And that's exactly what's starting to happen in Canada. And it may actually be coming to the US sooner than a lot of us actually anticipated. Hi, my name's Michelle Brienza, your trusted mortgage agent. I hope everybody had a great long weekend. There's so many things that are going on that I want to discuss. And, Canada just posted in July a bunch of job losses. Manufacturing is starting to slow down. Exports are weaker. Companies are cutting back. And the cracks in the economy are finally starting to show. So that's why many analysts are actually saying to watch for variable rates, and because they think that once the Bank of Canada starts to actually see the slowdown, they're going to have no choice but to ease on interest rates. So that is going to be coming. But then there's the other side of that. Here's the paradox, they say. Bond yields are actually jumping. So the 5-year Canada bond, which directly sets fixed rates, I've talked about that in the past, is actually following the US 10-year, and it's going higher. Why? Because markets are actually having some global pressures. There's the US court rulings, there's tariffs, there's stubborn inflation, there's heavy government borrowing. We've talked about that. And when bonds rise, fixed rates actually rise with them. So, right now, homeowners are caught in a little bit of a push and pull, I guess you can say. On one side, the economy is weakening, which is lower variable rates. But then there's the other side, which is the bond markets, and those yields, they're climbing. And that pushes fixed rates higher. So, I guess why that's important is that you really should know your options. For those of you that have mortgages that are coming up for renewal, you're going to want to take a look maybe at fixed rates. But if you have HELOCs or variable rate mortgages, you might anticipate those coming down. So it's an interesting time right now. You're going to want to definitely pay attention to the bonds. Big picture, Ottawa and Washington, they're both facing a slowdown in growth, rising debt. And it's not just a matter of, like I talked about, who's going to cut first, but, what's going to be happening with variable and fixed. It's kind of like this interesting dynamic that's happening at this point in time. So as always, if you have any questions, any concerns, there's probably going to be a lot of confusion. I thought rates were coming down. Yes, but fixed rates are going up. So I'm definitely sure there's going to be confusion over the next little bit. So, if you have any questions, any concerns, please give me a call. I'm more than happy to explain it all to you. And I wouldn't wait 30 days before a renewal. If you have renewals coming up, I would definitely start 3, 4, 5 months beforehand so that you can really start paying attention to things. And if you feel like there's a low point that you can lock in at that time, actually, believe it or not, there's options out there. Anyways, for a customized consultation, give me a call. Until then, have yourselves a great week. Be well.